Hey everybody, how is it going? Welcome back to my channel. In this video, I want to talk about the yield curve inversion. It inverted a couple days ago, and it seems like that's what everybody is talking about. I looked at a few videos and read a few articles, just trying to get a little bit more of an idea what people think, and I really didn't see anybody saying what they planned on doing. So in this video, not only am I going to go over the yield curve, but I'm also going to tell you what I plan on doing about it with my portfolio. I'm also going to go back to my charting software, and we're going to take a look at the point in time when the yield curve inverted in the past and how long it took for us to actually go into a recession and how the stock market performed in those periods, just to get a better idea of historically what we can expect going forward. But I'm going to start off with this article just to read some of the basic definitions here, and then we'll skip past this. But this article says, what is a yield curve and why are investors worried? And it says, here's why this important bond market indicator is flashing a warning sign. Now, I've heard several market players that have many years of experience say that they don't trust CEOs, they don't even trust the numbers most of the time, and usually they don't even trust their spouse. But what they do trust is the bond market. So when the bond market speaks, some of the smartest money on Wall Street definitely listens, and they're usually the best informed people on Wall Street as well. But zoom down here and read the article a little bit. It says, what is the yield curve? The bond market is loaded with jargon and complicated concepts, but this one is a bit more easy to understand. At its most basic level, the yield curve is a way to visualize the relationship between yields across different maturities of U.S. government bonds, from 3-month bills all the way to 30-year bonds. The focus is usually on the yields of the Treasury notes, starting with the 2-year and the 10-year note. That is the one that most people talk about. I know there's been a lot of debate about which ones should be followed, but that seems like that is the one that is referred to the most. But it says, when the economy is strong, the interest rates are stable, and the yield curve slopes upward. That's because shorter duration bonds usually have lower yields, and longer term bonds have higher yields. Investors typically demand a higher return from longer dated bonds because of the risks associated with tying up money for longer periods, and especially inflation. But the yield curve isn't static. The shape of the yield curve is continually changing along with the ups and downs of the bond market. So here's a typical graph on how it can fluctuate up and down. But let's get into the more juicier parts. They talk about what is the inverted yield curve. So there's basically 3 ways the bond market players describe the yield curve: steepening, flattening, and inverted. Steepening is when the gap between the short and long-term yields are rising, and a flattening is when the gap is shrinking, and an inversion is when the short-dated bonds yield more than the longer-term ones. So it says, now with inflation running hot, interest rates rising, the spreads on shorter dated treasuries are rising faster than long-term dated ones, leading to a narrowing of spreads among the different maturities, aka it's flattening. Now, scroll down here and it says, does an inverted yield curve predict a recession? And it says, when it comes to the yield curve, the attention is usually on the difference between the 2-year note and the 10-year note, sometimes called the 2-10 spread, or a variation of that lingo. Now, historically, an inversion of the 2-year to the 10-year relationship has been a reliable harbinger of a looming recession. 2 consecutive quarters of negative economic growth. That's what a recession is. And it says that's a measure of the gross domestic product. Officially, which officially designates a recession. I guess I got to learn how to read sentences a little bit better, but you get the point. In an intraday trading session on Tuesday, the spread between the 2-year and the 10-year briefly inverted. Now, I remember back in 2019 when the yield curve inverted. It inverted very briefly, so I thought it was kind of a false signal. But then we had, the COVID collapse a few months later. Now, it's debatable whether even if the yield curve didn't invert, would we have gone into a recession? A lot of people say yes, and I probably believe that as well. When you shut down the economy, it's kind of hard not to go into a recession, no matter what the yield curve is doing. But we'll leave that to another debate. But this goes on to say that since 1978, there have been 6 recessions recorded by the National Bureau of Economic Research in which the yield curve inverted on an average of 12 months prior to the recession's start. It says some recessions take longer to evolve than others develop more quickly, as was the case between August 2019 inversion and the beginning of the recession last February. Now, in 1998, the yield curve inverted, but a recession was averted as the Federal Reserve moved quickly to cut rates. So that's an important thing to remember. But if you scroll down, it talks about when the yield curve inverted and when the recession actually began. The last 6 times that it happened. The first one was in 1978 is when it started, August of 1978, but we actually didn't even go into a recession until January of 1980. So it took a full 17 months before we got the quote-unquote recession. Now we had a yield curve inversion not long after the recession was over. It happened again in September of 1980, and the recession began in July of 1981, so that took 10 months. But just reading here, you can see how many months it took to go into a recession, and the average was 12.3 months. So when we get into the charts in a minute, we're going to see how the market typically acts. Now, this is the chart that a lot of people have up and are talking about. Just shows when the yield curve inverts. So when it's below this line, it's inverted, and the shaded area are the recessions. So here is the 1978 inversion. As you can see, the yield curve remained inverted for quite a long time before we got that first recession in January of 1980. And then you can see as we were coming out of that recession, the yield curve then inverted again, stayed inverted for a while, and that led to another recession. Now, once we came out of that recession, it didn't invert again until January of 1989, and then finally in July of 1990 is when we went into that recession, and the Saddam sell-off happened in the market. As you can see, the yield curve didn't invert again until February of 2000. It led to the dot-com bust, or I should say the dot-com bust came after it. And then we didn't have another inverted yield curve until February of 2006. And then, of course, the financial crisis followed soon after that. And then we had this little tiny blip here where it inverted very briefly before, COVID hit everything, and then we went into that recession. So it's usually a pretty good indicator if we're going to get into a recession. Now, the way I like to look at it is the yield curve inversion does not cause the recession, but it shows you when the economy is a little bit weaker. It's more susceptible to that blow. It's kind of like a boxer on the rope that's already taken a pretty stiff combination and a little woozy, and if one more big right cross and probably going down. That's the way I like to look at it. The yield curve inversion doesn't cause the recession, but it's telling us that the economy is in a fragile state and we are more susceptible to a recession. All right, so let's jump over to my charting software and take a look at what the market did when the yield curve inverted and when the recession started. Now, I put these points on the chart just in that month. It didn't give you the exact day, but the Y, of course, denotes when the yield curve inverted, and the R indicates when the recession started. But you can see in 1978, that first time it inverted in August of 1978, kind of chopped around for a little bit, and then it kind of fell off a cliff. Not a huge fall off, but then it grinded around for a little bit, rallied slowly. It was pretty choppy, obviously, the whole way up, but when we got the official recession in January of 1980, that was 17 months later. You can see it ran up just a little bit longer, and then, of course, we had a big fall off. Now, this was a pretty tough time for the U.S. economy, so remember, we went into that recession not long after that, so let me walk this thing forward. You can see the yield curve inverted just a few months after we came out of that recession. Let me walk it forward. And you can see when the recession started. So we're basically in a range for about 10 months until the recession started, and then it rolled over about a month after that. So it seems like selling just before the official recession starts is probably the best thing so far. Now, the next one didn't invert until January of 1989. So let me skip this thing forward. There is the yield curve inversion right there. So let's walk it forward a little more. And actually on that graph, when I was reading that article, it said that it only took 6 months before the yield curve, after the yield curve for it to go into a recession. Obviously, this wasn't 6 months; it was 16 months. So I realized that after I already got done recording that previous part. So when you factor in the extra 10 months, we didn't go into a recession on an average of 12.3 months after the yield curve inversion. It actually took an even 14 months. So that's just something I wanted to point out. It actually, we don't go into recession even longer. So it takes even longer than the 12.3 months. But you can see we had that yield curve inversion in January of '89 and then July of 1990, right before the Saddam sell-off. You can see we went down pretty hard after that. So it looks like you definitely want to be selling once we get that official word of a recession, even if they're saying that, everything looks like it's probably going to be okay. The worst is over. It's already priced in. Judging by these first three examples, you can see that it definitely wasn't priced in. There was worse yet to come. Let's go to the next one, and that was February of 2000, and that was the dot-com bubble. Let me walk it forward a little bit more. That's the yield curve inversion right there in February of 2000. And you can see the market kind of went sideways and then it just started to fall over. Now, this is the S&P 500. If I had a chart of the NASDAQ up, it would look much worse than this. But you can see, we got that yield curve inversion. We had all kinds of things happening in 2000. The dot-com bubble. We had 9/11 coming in 2001. So, there was all kinds of things that were going on. We had Enron, we had WorldCom. There was all kinds of things going on in that, that 3-year bear market that we had from 2000 to 2003. So there was just, one thing right after another. But looking at the first yield curve inversion, you can see went sideways for 6 months, started to roll over. Once we finally got that word for a recession, it had already gone down quite a bit. Probably started to rally, and everybody was thinking it was already priced in, but then we rolled over and we went much lower. It was a terrible market. This is when I first started trading. It was just such a horrible grind. If you think this last year or so has been very difficult to trade, you should have started trading back then. Hopefully it doesn't take that long for the market to get into a decent tradable environment. But let's go to the next one, and that was in 2006. So let me zoom it forward just a little bit more. So that first yield curve inversion was in February of 2006. And you can see the market just screamed higher. I might have to back this thing out just a little bit more so we can see all of it, because the recession didn't happen for 22 months. But you can see for a yield curve inversion kind of grinded higher a little bit longer, for a little bit. And then we had that rollover, and then we kind of had that run up into, the housing bubble, and it was really choppy until we finally had that financial crisis and that deep recession. And you can see you definitely wanted to be out once the official word of a recession happened, because the market just fell off of a cliff. And then we'll skip forward to COVID in 2019, and of course we all remember how that market was. But there was the yield curve inversion in August of 2019. Let me walk this thing forward just a little bit more. And then you can see once the official recession happened, everything kind of fell off a cliff. But I think everybody kind of saw this coming, but we didn't think it was going to be this deep, this fast. I had no idea it was going to become, this deep, this fast, or I would have been shorting everything in sight, buying puts all over the place. But hey, hindsight is 2020. But in conclusion, what I plan to do is I plan on not doing much in the short term. But if we do get a rising market, I plan on trimming some positions down. I never like to get completely out of the market. Seems like when I do that, I always mistime everything. It's easier for me to just kind of lighten positions up and then, kind of buy back in once, the market starts to pull back, or, we get better buying conditions. But that's what I plan to do. I don't plan on doing anything in the short term. I don't plan on doing anything really drastic. That can change because, as the market, keeps going forward, other information is going to come out. But, if everybody out there is, thinking about, selling right away, that might not be the best move, because you usually get a little bit of a melt up, before you get that big rollover. All right, so now I'm going to get into a question. I had a question from my buddy Thomas, and he was asking about selling a call. He said he sold a call on some shares that he owns, so he sold a covered call. And he said he sold the $21 strike price, and today the price has crossed through $21 a share. He's never had one close in the money before. He's not sure what to do. And I should have asked you what the name of that company was so we could have went over their chart. But I'm in a similar predicament with a company I own, Southwest Energy. I own 600 shares of Southwest Energy in my Interactive Broker account. This is my trade station, and just a little bit easier to explain on the trade station setup. But anyway, I sold the $7.50 strike price when price was right here, right around $6.60, and price has moved substantially higher since then. And even yesterday, it was actually above $7.50. It's pulling back a little bit today, but I have 8 days left on the contract. So what am I going to do? What I'm personally going to do is just sit tight, because I think we're going to have a reactionary move down, and it's probably going to end up closing below $7.50. Now, if I didn't want to do that, what I could do is buy those calls back. Now, I sold the $7.50 strike price when price was at 19 cents a piece, or 19 bucks a piece. So I collected $19 times 6. So I collected right around 110 bucks after commissions. Now, right now, that contract is worth 25 cents or $25. So if I wanted to close out the trade, I could just buy these back for 25 bucks a piece. I collected 19 a piece, so I'm going to lose $6 a piece per contract. So 6 times 6, I'm going to lose 36 bucks plus the commission. So that's not the end of the world either. Now, I personally think that price is probably going to pull back. That's why I want to sit tight. If I thought price was going to scream to $10 a share, it would make more sense for me to just buy these contracts back and lose $6 per contract. And then if it runs up to $10, I'd still be in the stock, and that's a much bigger gain. But the point of these contracts is to have them go to zero. When the price actually goes up, when you sell a call, you're losing money. You actually want the contract to expire worthless. So that is what I am personally going to do. Hopefully that answered your question. If you do decide to just sit tight, like for me, like say I decide to just sit tight and price closes at $7.75, the following Monday I would log into my account and the shares would be gone, and I would be credited with 600 shares times $7.50. So that's not the end of the world either. I own these shares for about $4 a piece. So if I have to sell them at $7.50, it's not that big of a deal. But I'm thinking that the market kind of zigs and zags. You can see after this move up right here, we had that pullback. That's what I'm kind of thinking is going to happen. And if we get that pullback, chances of it turning around and screaming back over $7.50 before next Friday, I think, are pretty slim. And well, actually, I had a position in this account that did the same thing a few weeks ago. Let me go to WTI. Let me zoom in a little bit closer here, but I sold the $6 call on my WTI contracts when I think it was right about here. I sold the $6 call, and as you can see, just a couple of days later, this thing went to almost $7 a share. But then, what goes up fast usually comes back down. I didn't think it was going to come down this far, this fast, or I would have been happy to have my shares, be taken away from me at 6. But I think right around here is when the contract expired. So it closed well below $6 a share. But what I figured was going to happen after we had a sharp move up, there was going to be a pullback. It was going to close below $6 and maybe round back up, especially with how hot oil has been. But I didn't expect WTI to come crashing down. But what I like to do is sell them as they're screaming up, because chances are they're not going to be going up that much longer. And then also it's probably going to have a reactionary move down. Plus, when you have a position that is screaming up, the volatility expands and you get to collect a lot more money than you normally would if it was just moving around in a normal fashion. So hopefully that answered your questions. Now, I did look back at some of my notes. I went back a couple of pages and I counted them up. I sold covered calls on 86 different positions over the last several months. and 8 times the shares got called away from me. So 90% of the time I ended up just collecting that money and keeping it. And where I like to sell them, I like to sell them at a 20 delta. So right here is the delta. You can see right now with price trading at $3.84 and there's 14 days left on that contract, the chances of it making to $5 a share is only a 13 delta. So there's only a 13% chance of it making it there. Let me go to another stock where it has some more strike prices. Here's another stock that I own. It is CleanSpark. There's 14 days left on this contract. But what I like to do is sell that $20 or that 20 strike price. So you can see right here, the current price level is $12.60. The $15 strike with 14 days left is at a 24 delta. So there's a 24% chance that it's going to make it to $15 in the next 14 days. I could collect $30 a contract if I decided I wanted to sell them today. Or if I wanted to be more conservative, if I only wanted an 11 delta or an 11% chance of it crossing $17.50, I could sell this strike price. So when there isn't a 20 strike, there's either a strike a little bit lower or a little bit higher. I have to make that decision. Do I want to be closer to the money and collect more premium, or do I want to be a little bit further away from the money and be conservative and collect a little bit less premium? Now that's something you have to answer. Personally, I like to shoot for the 20 delta, but when you have like something in between like this, and that's what you're going to find quite often, you just have to make that decision. But hopefully that answered your question, Thomas. That's why I wanted to make a video on this. I didn't want to have to type all that crap. That was way too long-winded. But if you have any other questions, just let me know in the comments, Thomas, and I'll try to answer them for you. All right, so now I'm going to go over my trading activity for the day. I'll try to go through this quick. This video has dragged on long enough. But the first one I want to get into is HUSN. This was my day trade for the day. Before I get into it, please remember, not a financial advisor, just trying to show you how I trade. Please make all of your own buying and selling decisions. Now, I do have a Patreon group. Link is down there in the description. $10 a month. I'm in that Discord every day, and I put out a pre-market watch list video just to show you all this stuff that I'm looking at before the market opens. That is not required, though. Simply liking the smash button for me would be greatly appreciated. But this is part of my gap and go strategy. I look for a stock that is gapping up, and I try to catch the run, with all that momentum potentially coming in. So let's go to the... Actually traded this one on the 2-minute chart, or was it the 3-minute chart? It was the 3-minute chart. There we go. Let me back this thing up to the beginning of the day. You can see we had that gap up followed by a sell-off. Now what I'm doing is waiting for it to find support at this white line, this 8-period exponential moving average. Let me just show you real quick. First I start with the minute chart. I wait for it to touch the line and start to round up. If it breaks down through it, I go to the next time frame, which is the 2-minute. Then of course I got to resize the darn chart. That's why I don't do this when I'm trying to make the video. We had the 2-minute chart. It didn't really round up on the 2-minute chart, broke down through it and stayed below it. So I went to the 3-minute chart, and that's when it found support, would not break down through it. I saw this very easily definable ceiling, and I wanted to buy once it broke above it. So I put in my order for 248, executed my shares at 249. I think right about there. Maybe it was right here. Anyway, as soon as it broke through that little ceiling, the stock kind of took off. I put in my order to sell at 269, so I sold it right here. You can see that I sold way too soon, but that was 8%, and I'm usually happy to get between 7-8%. But man, if I would have just held on for another minute or two, I could have got out well over $3, and that would have been a much bigger gain. But you can see following the rest of the day so far, there's still time left in the trading day. It's just kind of been fading ever since. So, but this is the trades that I like to do, these little rounded bottom trades. Sometimes they work out, sometimes they don't. This one happened to work out. Let's go back to the daily chart. Oh, and just an update on another position I had. I actually bought calls on the SQQQ. when the NASDAQ was going above that 200 period simple moving average, I thought there might be a pullback. Let me actually jump over to the QQQs real quick. It was right on this day right here. I bought at the end of the day because I was thinking a lot of times they like to run these things just over those major moving averages and then send the market right back down. That's what they did right here, but I've seen them do it many times in the past. So they kind of do this to suck people into the market. Everybody's thinking, hey, it broke the 200, we're home free, and then they pull out the rug. So that's when I like to go short the market, just take a small position, and pulled all the way back to the 8-period exponential moving average. So I bought the $32 SQQQ calls. So let me jump back to that. Bought the $32 SQQQ calls when the SQQQ was right down here. I paid 55 cents a piece. I sold some of them yesterday, or I'm sorry, was it yesterday or the day before? Anyway, I got rid of some of the position at $1.06, so almost a double. And then yesterday, right before the market really rolled over, I sold the rest of them at $1.45. And if I would have held on today, I think the last time I checked, they were worth $2.50 a piece. So I could have made, 5 times my money if I'd have just held on one more day. And, it really sucks because when I was looking at the QQQ, I figured we'd have a pullback to that 8-period exponential moving average. And that's exactly what we did. I just happened to sell it just a little bit too soon. They were expiring today. So I figured if we had a move up today, those things would have taken a big hit with only one day left. But the market has remained weak. The volume hasn't been so bad. If the volume really accelerates to the downside, going into the close, it's going to be a nasty down day, and that's going to be a bad a day from a technical perspective, but we'll have to see how the market closes. Just a quick update on some of my other positions. I'm just sitting tight on Nile. Even though Nile is pulling back, I'm not going to get out of this trade until it breaks this support level right here. So I'm going to give it just a little bit longer. I'm down a little bit, but sometimes these can take, 6, 7, 8 days before they finally turn around. And I'm still sitting tight in my Mullen calls. It's not really selling off too hard, but after this trading day right here, I got kind of worried because you see so many charts after they have a run up like this, they have that big move off of those moving averages, and if it sells off the next day, it usually has a lower probability of continuing higher. So as long as it can hold above these moving averages, I'm going to stay in those calls, but I'm pretty much running out of time in those calls, so gonna have to make a decision here soon. But that is my trading activity for the day. If you guys have any questions or if you see any cool trades setting up, make sure you let me know down there in the comment section. I am always interested in seeing good stocks that are setting up. I can't see every single one of them, and my screens happen to miss a lot. So any information or any ideas you can give me down there in the comment section would be greatly appreciated. That's about all I got. Have a great weekend, everybody, and until next time, take care.